Open any banking annual report. You will find dozens of ratios: NIM, CASA, GNPA, ROA, credit growth. It can feel overwhelming, but behind all those numbers are just 5 simple questions. And once you understand those questions, analyzing any bank stock becomes much more straightforward. Today, we will look at the 5 numbers that matter most and how investors use them to evaluate a bank. Before looking at the numbers, let's understand how a bank works. You deposit money in a bank. The bank pays you interest on that deposit. It then lends that money to someone else at a higher rate. The difference between what a bank earns on loans and what it pays on deposits is the foundation of its business. In simple terms, deposits are the raw material, loans are the product. The bank's job is to maximize the gap between the deposit rate and the lending rate, while making sure that the loans it gives out actually get repaid. Once you understand that, most banking ratios start making sense. Instead of memorizing ratios, start with 5 simple questions. 1. How profitable is the bank's lending business? 2. How cheaply can the bank raise money? 3. Are borrowers repaying their loans? 4. Is the loan book growing responsibly? 5. How efficiently is the bank converting its assets into profit? Each question maps to a number, and together those 5 numbers tell you far more than any one ratio ever could. Let's look at them one by one. To make this practical, we'll use ICICI Bank and Kotak Mahindra Bank as examples, not as recommendations, but to see how these ratios work in the real world. The first question is, how profitable is the bank's lending business? That's what NIM measures. NIM stands for net interest margin. Think of it as the gap between what a bank earns on its loans and what it pays on its deposits. The wider that gap, the more profitable the core lending business. Both ICICI and Kotak operate with relatively strong lending margins. In FY26, ICICI reported an NIM of 4.32%. Kotak reported 4.6%. What does this tell us? Kotak earned a slightly wider spread on its lending business. That gave it an advantage in lending profitability. The second question is, how cheaply can the bank raise money? To be able to lend, a bank first needs funds. It gets those funds primarily from deposits. But not all deposits cost the same. A savings account pays 2 to 3%. A fixed deposit pays 6 to 7%. A bank that relies heavily on fixed deposits starts with a higher cost of funds, which leaves less room for profit. This is what CASA measures. CASA stands for Current Account Savings Account Ratio. It tells you what share of a bank's deposits come from current and savings accounts, the cheaper sources of funding. A higher CASA ratio generally means lower funding costs and better margin protection. In FY26, Kotak Mahindra Bank reported a CASA ratio of 43.3%. ICICI reported 38.6%. What does this tell us? Kotak had access to cheaper funding. The third question is, are borrowers repaying their loans? A bank can have strong margins, it can be growing rapidly, but if borrowers stop repaying, those profits can erode very quickly. That's where GNPA comes in. GNPA stands for Gross Non-Performing Assets. In plain terms, these are loans where the borrower has stopped making payments for an extended period of time. GNPA is expressed as a percentage of the bank's total loan book. Imagine a bank has lent out 1 lakh rupees. If 2,000 rupees worth of those loans stop being repaid, the bank's GNPA becomes 2%. The lower the number, the cleaner the book. Banks also set aside money to cover these bad loans. That is called provisioning. After provisioning, the net NPA numbers are even lower. In FY26, ICICI Bank reported a GNPA of 1.4%. Kotak Mahindra Bank reported 1.2%. What does this tell us? Both banks have maintained strong asset quality. Kotak's loan book is slightly cleaner, but the difference is not dramatic. The fourth question is the loan book growing responsibly? Banks grow by giving out more loans. Credit growth measures how fast that loan book is expanding. Growth matters, but it needs to be read carefully. Very rapid growth can sometimes mean a bank is lending aggressively. By approving loans it may have rejected earlier, or by expanding into riskier borrower segments. That is why credit growth should always be read alongside GNPA. Growth is only healthy if the loans being given out are also being repaid. In FY26, both ICICI Bank and Kotak Mahindra Bank grew their loan books by approximately 16%. That is strong, broad-based growth, and in both cases, asset quality held steady. That combination, growth and clean books, is exactly what investors look for. The fifth question is, how efficiently is the bank converting its assets into profit? For a bank, assets mainly include loans and investments, money the bank has deployed to earn income. ROA, or return on assets, measures how much profit the bank generates from every rupee of assets on its books. It is one of the most widely used measures of overall banking efficiency. In FY26, ICICI Bank reported an ROA of 2.33%. Kotak Mahindra Bank reported 1.97%. This tells us that ICICI generated more profit per rupee of assets. Now let's look at both banks together. Notice what happens when you read across the row. Kotak leads on margins, Kotak leads on funding, Kotak leads on asset quality, and yet ICICI generates more profit per rupee of assets. How? Because ROA captures the full profit engine of the bank. A bank with lower NIM can still generate higher ROA if it earns more from fees, runs more efficiently, has lower credit costs, or uses its assets better. This is why investors rarely stop at a single ratio. The real story emerges when the numbers are read together. So the next time you look at a bank stock, don't start with the price. Start with the 5 questions. Pull up the bank's annual report. Find the NIM, the CASA, the GNPA, the credit growth, the ROA, and read the pattern, not any single number. That's the entire framework. Successful investing does not begin with stock prices. It begins with understanding the business behind the stock. And for banks, these 5 questions are a great place to start.